All right, good evening, guys. Ken at Tortoise Capital. This is the nightly strategy podcast for August 17th, 2021. So let's take a look at the market health check. We're still long from a COTA 2 entry, although we're starting to see some weakness forming in the last 2 days that are reminiscent of the last little bit of selling pressure that we saw in here and in here. And in both cases, the market did not melt down past the PSAR, did not get to the Bollinger Band mean. It resumed the upward travel. So we're mindful that can happen. But this one feels materially different. So let's try to describe what we're seeing and then seeing if those feelings are useful and what it means for tomorrow's trading plan. All right, so we had a bit of a gap down. Let me zoom in here a little bit so we can see. All right, so we had a gap down from yesterday's close, which is closed at an all-time high of a close. A new 10-day and 30-day, an all-time high was achieved during the day. And then today, big gap down on hints of bad earnings in the Main Street stocks like Home Depot and basic staples. And then that sold off sharply all the way down to the PSAR, where it held support and then came charging back in the afternoon to recover most of those losses to finish out of the river above the spine of the dragon. And so there was about a 0.6 or 0.8% loss. But now we've had 2 days in a row of sharp selling and then big recovery. Then when you add in the big gap down and harsh selling, that was a bit of a bumpy ride. And the recovery today was not as large as the recovery yesterday. So if we just compare that to yesterday's gains, not as strong on the follow through, and the sell off today was larger. So that feels troublesome. Tomorrow's PSAR is going to be right around 442. Got the edge of the river, the RL90, and the belly of the dragon here at 442.5. Edge of the river 443. So if you're still long this market, then to me, your stop has to be edge of the river. I just can't see any reason to let this get further south than the edge of the river. 443 and a third to me is just kind of a no-brainer. The daily low here, it's about 1.5%, and then here's the Bollinger Band mean at 438. And to be fair, here's the 2.5% sell-off. Stop down here at 436. But to me, that just feels like maybe if you're a long-term swing trader or position trader, you could let it get that far. But to me, I don't see a reason to be that exposed. Further stops on the downside, edge of the river, 433. Z2 is 428. If you come all the way over to the RL10 belly, that's at about 430, and the belly of the dragon in here. So there's lots of different support levels we could identify, that would take us all the way down to the 30-day low for that matter, which is well outside the Z3. So every one of those there's an argument for each one of those to be a stop. But for me, I want to preserve these hard-fought gains of the last 30 days. We've already seen in the last 30 days a sell-off that took you from plus 2Z all the way down to Z minus 1 at the southern edge of the river. So that would be the equivalent of this move from Z2 at 447 to take you all the way down to 433. And if we looked at that on just kind of a percentage move basis, in a matter of, that happened in 4 days. If I just map that move here, that one takes you well past, the magnitude of that move takes you well past the edge of the river and all the way down basically to Z-2. So I'm not willing to give back that much, which would take us all the way back to the belly of the RL90. That's why for me, either this stop here, a line in the sand at the edge of the river, even if you just take half there, that makes sense to me. And then I certainly would not let it get past the PSAR again. That's my take. Let me know in chat if you found that helpful. So looking at the sectors today, the S&P was down 2/3, minus 0.66. Treasuries were basically flat at 148.8, down just 0.004. The Dow was down 0.77, which was a reversal from yesterday's structure where the Dow was better. The big techs were off 0.88, and then the two laggards really got smacked, minus 1.22 in Russell. So there's no belief there. And then the globals, fearing a changing in the world order and a disruption of oil supplies, minus 1.83. Let's look at the things that outperformed. There weren't many. In the sectors, there's ARC Genomics and agriculture. Didn't lose as much, down only 0.62. You had wheat and precious metals, minus 0.4. Mexico, basically flat. Consumer staples was the only sector spider that outperformed the Dow. And so we talked about the staples yesterday being a place of conservative capital protection at a time with where bonds aren't really protecting you at all. And then S&P Biotech, plus 1.57. And that's it. Everything else weaker than the S&P. So the VIX, 3.3. You had Virgin Galactic 0.36, minus 0.36. And again, our two little tech heroes, Microsoft and Apple, did better than the techs, which were off 0.83 and 0.88. So they were off less, and they were slightly better than the market. So there was somebody buying those today. On a day when the market was being sold and the tech sector was being sold more, somebody was buying Microsoft and Apple. So that's a good sign for them. All right, so signs of weakness and underperformance, going from, I guess, bad to worse, if you want to call it that. So we had oil exploration and financials off 0.7. S&P Tech off 0.83, slightly better than the NASDAQ techs. Then we have a cluster here of Brazil, ARC Innovation, oil, energy, blended commodities and materials off 1.1. The two lumbers off 1.37 and 1.45. And that was on weakness in the home builders, which if that is slowing down, then that's going to naturally affect lumber and symbols like Home Depot, which also suffered today. Moonshots off 1.68. The FANGs off 2%. Commercial real estate 2.2. Marijuana 2.25. Consumer discretionary 2.37. So when I like that comparison between XLY, consumer discretionary, and XLP, consumer staples. That gives you the defensive play, staples, versus the speculative play, the discretionaries. And this was a vote for defense today. You get lithium off 2.77, clean energy, Bitcoin off 3.5, blockchain, Ethereum, and the blended large cap crypto was off large 15%. And then the metals. This would be a sign of industrial slowdown when you got Alcoa and Cliff off 3 and 4%. Tesla down 3%, broke the 700 magical barrier, making Michael Burry look smart. PayPal, U.S. Steel off, Coinbase off, TX, the steel maker, off. So broad-based weakness across the board. Not a good sign whatsoever. Okay. Let's look at the trades today. There are 2 to check. Again, if you want feedback on your trades, post your best work, post your trade frames and your closed case studies, and we'll talk about them. All right, so here we have, this is, I don't remember, this was Matthew, looking at Alcoa. So the first one was a collapsing dragon. Let me try to scale that out a little bit. Yeah. First one was a collapsing dragon with a nice tight stop at the shelf of the dragon and the PSAR flip. So he's played that very nicely. Gave it a chance for a second fail, but it didn't. And on the PSAR flip, he gets the RLXD for 0.77. There was a rejection of the VWAP here. Now, this would have been tempting, except everything was failing today in a large way. So don't blame me on that one. This was on a down day when materials were worse than the S&P, an opportunity for the PSAR flip and this is a Kata 2 on the downside because you have a high, a lower high, a third or a second lower high, and a rejection at the VWAP. So that would be, that RLXD is like a pocket, and you are front running the collapsing dragon, which would be in here. So this could have been a collapsing dragon here. This was a collapsing dragon here, especially when you get a lower high, another lower high, and this one couldn't even get out of the dragon. That's the killer entry. And then even if you don't get that, getting this at the Z3 breakdown after the pinch, ooh. So there was probably another R inside here given. We're not taken. This is a reasonable effort in the afternoon because the broader market had started to recover. I like the scratch or the fractional loss. I like the effort. I love this one for 2.7, and then you have a nice couple of trades inside here. So pretty good work across the board all the way through. And remember, on down days, finding the losing trades, the movers to the downside, those collapsing dragons are everything. Don't miss those. Here's a handful from Luke. This one is in EWZ on the 500 ticks. He goes for the short here. This is perfectly played. I might have scratched. I don't mind so much the, that's only a half an execution art. You gave it room. I like the re-entry here. I would have preferred this one because you have a high in the dragon, a lower high. That's your RLXD, and that summer turned to winter, and it broke below the VWAP and the dragon. This could have been a little earlier. That would have made this a scratch. Still, that's reasonable. This one crushed. The re-entry was beautiful right after the RLXD and a collapsing dragon. I'd have been tempted here after it gets to the Z3 holds and then rejects. That new low right there is really attractive to me. But still, that's 2.6. Reasonable stop and reverse. Good scratch. This one, let's get paid more on that to cover the 0.5. Like, if you were as quick to cash them as you were to protect, we'd have gotten paid in here like a 1, 2, 3 would have covered that one. But I love the re-entry. This was an opportunity for a COTA 2 second entry because you got a Z3 breakout crossing the VWAP. It failed to fail, and that's a beautiful sniper exit. So all the way across the board, really, really nice work from Luke. All right. All right, next up is the daily reports. Let me let the first dashboard show for you. Boy, bad lag tonight. We got thunderstorms in Kansas. Okay, so we've got still in bullish quiet. We are overbought on the longer term basis, but you see the weakness coming in on the 2-day cycle. The percent stretch has turned back into the red. It's still bullish, but red, meaning this is one of the worst readings in the last 180 days. ADX is very weak at 10, so the steam to the upside is falling, running out of steam, I should say. Risk Z is still showing the potential for the upside, and it's true we're only 1.5% from all-time high, but boy, this doesn't feel like a market that should go higher, which doesn't mean it won't go higher. And if everybody feels it shouldn't go higher, then that's the path of that's the path of most surprise, perhaps, and that's the path of maximum pain. So this little move here to the upside. Now, if that stalls right here, and risk C starts getting worse, then what we have is something like a that descending into volatility is what that looks like, and then that would lead to a potential volatility move down here. So to me, if you're short-term guy, you may want to be looking at VXX for your intraday trading opportunity tomorrow in the next couple of days. IWM and EPP firing on the overreaction, and EPP also firing once more on the channeling. Strength in the min pains in the areas of Johnson & Johnson, McDonald's, Merck. And then the industrials were having trouble today. You can see Home Depot, Boeing, Caterpillar. In the Dow Tactical Summary, up next. All right, so we have only 3 dojis tonight. We have plenty of auto framers, however, and plenty of 5DDs to frame. I like Home Depot because it's a channeling and an overreaction. It's a great company, and it's also #1 on the auto framer. So, and it had the biggest, sell off on the 10-day breakdown. But you can see Johnson & Johnson, Merck, Travelers, and Procter all had big breakouts to the upside, defensive plays. Intel is interesting. It's a 5DD, and it also was the other stock that broke to a 10-day low. So it's been lagging in the chip war, so there may be some more downside pain and suffering there. Next up is the ETFs. All right. In the ETFs, we've got only 2 dojis. We got plenty of auto framers, though, and breakouts to the upside in consumer staples and healthcare, the defensive plays. But otherwise, big breakdowns more broadly in metals and mining, oil exploration, Brazil. Clean energy also got smacked in the mouth today with a 10-day and a 1-month low. The globals didn't fare much better. Like with emerging markets had a 10-day breakdown, and so did Asia less Japan. So there's no joy in the globals. There was no safe havens today except basically treasuries being flat. And then the consumer staples. So I guess if you got to be somewhere, those XLP companies are a good choice. In the auto framer, we have a dozen symbols that test out well. I like the treasuries on that one because they did not sell off during this latest run up in the equities, so I like them. I also like the Russell. So if we were to see some kind of recovery trade, the Russell has a lot of things going for it. The auto framer is good. It fired on the overreaction. It's got a great auto framer ratio there, and it's a favored trading vehicle. So that's one that should be on your list. Not many in the daily squeeze today. Only treasuries of interest to me. But I guess, like Microsoft is pretty close there at 2-1 with the rounding error on the daily squeeze. So Microsoft held off the sell-off today pretty well. So I like that. We'll go straight to the auto framer. Defensive plays are dominating. Again, as we've seen, the staples in healthcare. And then healthcare companies like Procter, Merck, Johnson & Johnson. And then you can see just from the sea of red just how painful the 2-day and 10-day selling has been, and how broadly that's affecting things. All right, so that's our quick look at the markets for tomorrow. Let's get our trades prepared, keep your stops honored, and manage your risk. And let's be ready for the day. Take good care. We shall see you tomorrow.